Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Wolverine World Wide Inc. So let's get started. Now, who are they? Well, first of all, this called my attention. They were up at least in the close of July 19th. They were up 9%. This seems to be related to UBS upgrading them to a buy. They have not been rated as a buy by many analysts and companies for a long time now. So it seems like they were upgraded. It seems like that had a pretty big effect on them, especially because they're a company, as you'll notice, that doesn't have a P/E ratio. That usually means it's negative earnings recently. So it seems like they're on a path to profitability. At least that's what the upgrade would suggest. Now, let's talk about who they actually are. First of all, they're a shoe company. So they have a portfolio of brands, of shoe related brands, and they operate mainly in the US, at least half of their sales, but they also operate in Europe, Asia Pacific, Latin America, Canada, and mostly is through wholesale. However, they do have some direct to consumer e-commerce and stores. So they own a lot of brands that you may or may not know. Some of them, Merrill, Saucony, and Sweaty Betty, and Wolverine if you want hiking or work shoes. And then you have brands like Caterpillar licensed shoes, Harley Davidson licensed shoes as well, and Hush Puppies if you like dress shoes. I think those are great dress shoes. Saucony also is something that I personally own and quite like. I think sometimes they may be even better than comparative running shoe brands as well. So basically, they're a conglomerate, and they used to own brands such as Sperry's. However, they divested from those. So right now, in their latest quarter, they're talking a little bit about stabilization. So basically, what they've done is divest stuff. They have sold the Hush Puppies IP in China, US, and Asia. Leathers business, they've divested too. So they've changed a bunch of stuff to hopefully become profitable again to get some more cash on hand. They paid down their net debt. So 55 million lower at quarter end 2024 compared to year end 2023. That's great. We love to see it. And then they finally reduced their inventory. They had so much inventory related to all of this euphoria from 2021, 2022 that then dropped the ball on a lot of these companies, especially retail companies. So they've been working down the inventory now, finally. And it seems like they're in a more healthy position when it comes to that. So they're stabilizing. It seems like they're going to be profitable again. So let's look at their quarter 1 2024 results. And it's very interesting because the way they're phrasing it here is that they beat their guidance. So their revenue is higher, their gross margin is higher, operating margin is higher, their earnings per share is higher. However, it's a little bit tricky here to see that because compared to their results, compared to previous quarters, they're down significantly. And if you look at the full year 2024 outlook, even at the second quarter outlook, you see a decline in revenue. And same with both the active group and the work group here. So there's going to be a decline in revenue, a significant one. So decline in the mid-teens or decline in the high single digits for the full year 2024 compared to the full year 2023. And this quarter has also been a decline, even though it beat expectations. That's when it's tricky. They're almost looking to phrase it as if they did way better than expected, but at the end of the day, they're not doing that great. So that's just something to note. Compared to the 2023 revenue, the numbers are going to be a lot lower. That is something to observe. Even though they seem to be stabilizing a little bit, but they need it because that's the way you survive through tougher times. So, they have a guidance for ongoing business. Basically, their revenue is going to be down about 14%. Their gross margin is going to expand a little bit. Their operating margin is too. And they're saying that they're going to have a EPS of 65 cents to 85 cents, operating cash flow here in the range of 110 to 130 million, and with 40 million of capital expenditure. So let's say what, 80 million of free cash flow, which is fine. And then they're saying that net debt is going to keep being paid down, so that's also good for this overall picture. Now, we have the short-term overview. Now let's do the long-term overview. So in general, you see a company that actually has struggled to even maintain that level of sales. Obviously, 2020 is a dip for reasons that we all know. But even then, their sales had been declining before that. And sure, they picked back up, but everyone was selling more with the euphoria in 2021 and 2022. Now the ball is dropping again in 2023 and almost certainly in 2024. So you see a brand that has gone through some cyclicality that even its competitors haven't quite gone through. So that's very interesting and does set out a few red flags here. Same with the net income. I mean, it's there, but it goes negative here and there, and that's very concerning. Free cash flow at least stays positive. So that's fine. At least they have some cash to do stuff with. But if you take out stock-based compensation, it's less than it would look like. And that's what I'm calculating here. I'm grabbing the cash from operations, I'm subtracting the stock-based compensation, and then subtracting, in this case, in the Excel spreadsheet, adding, because you're adding a negative number, adding the capital expenditures to get the free cash flow to equity, which is less than you would think because they do issue a lot of stock-based compensation. Look at it here, for example, in 2021, they had 86 million in cash from operations, but they issued 38 million in stock-based compensation. So pretty much about 40% of their cash from operations was stock-based compensation. That's something that they pay out in stock. That's more stock and less ownership for you. So I have to discount that out. Then I'm going to compare that number that I get to the revenues, and that's the average ratio that I'm going to get. The average is moved down by this negative number in 2021. They had negative cash from operations because of very bad changes in inventory. If we ignore that number, that average is about 6%. I'm not going to say that they're going to go to 6% immediately, but with sort of having less debt and maybe producing more consistently some free cash flow, I'm going to say that they're going to go from this 4% that they had in 2023 actually to 5% of the revenue gets turned to free cash flow in 2024, then in 2025 6%, and then it stabilizes at 7%. Okay? So, I'm going to grab the revenue estimates from Yahoo Finance. So for 2024, analysts say on the low end, I'm grabbing the low end to be conservative, that they're going to make $1.69 billion. And then in the year after, $1.79 billion. So that's what I'm going to roll with. And I'm going to say it's 5% of 1.69 billion. That's going to be their free cash flow. And then 6% of 1.79 billion. I hope I'm being clear here. I plug that all in to my free cash flow model, to my discounted free cash flow model. And with an 11% rate of return and a 2% perpetual growth rate, what I get is a fair value of equity of $60.47 once you divide it by the total number of shares out. However, if you plug in the net debt, you get a value post debt of $5.83. So, compared to where the stock is, it's nowhere near, honestly. It's nowhere near. And that's very unfortunate. It means that in order to get there, they either have to expand earnings by a bunch or pay down the debt by a bunch, hopefully a mix of both. But that's something that even with this rise here, the cash flow is just not matching there for me at least. And if you look at the long term, you also will see that this is not a well-performing company in general. They did better before, but if you look at 5 years ago, if you owned the stock 5 years ago, you would have lost half your money with it. So this looks a little bit like a value trap in some ways, although I would even argue that it's not even a value investment here because there's not that consistent revenue generation. And even though it may look like a fallen angel right now, it's just not it with the debt. It's just not it with the free cash flow that is kind of flat and the revenue that hasn't consistently grown. So, all in all, I'm just not convinced. Like there's an alleged recovery in their financials. They're saying, okay, we're gonna pay down debt, we're gonna change a few things around, we're gonna divest things. Sure, that'll make you more lean, but the years of mismanagement and the fact that at the end of the day, shoes have lots of competition, it makes me doubt its feasibility as an investment. What differentiates them from all their competitors is such a competitive place. If they can't compete based on the revenues that they're making, I, as an investor, am not interested at a baseline. And if that also translates to stagnant free cash flow and no profits, well, I'm even less interested. It would be interesting to track as it divests or sells certain brands. For example, if someone went to buy Wolverine Worldwide, that would be more interesting. But As is, I'm just not convinced I want into this business. But what performed well today may crash 50% tomorrow. So I'd be very cautious given its operating history. But if we see it down back here at a $5 level, then yeah, I'd be super, super interested in this company. And honestly, I could see it going back to that $8 level, $5 level, and reevaluating there based on its cash flows at that moment. So, all in all, I would ask myself, where do businesses find an edge? If you see a company that has declining business in a very competitive market, do they still have an edge? Right. And I think that's the case with Wolverine Worldwide, where maybe they don't have that edge and they need to find it. Until they find it, though, I'm personally not interested. Now, I hope you found this video super interesting. I certainly had fun analyzing this company. If you want me to analyze any other companies, please comment down below. I'll take a look. Thank you so much for watching. If you haven't subscribed yet, don't forget to subscribe and hit that notification button. Thank you so much and have a great rest of your day.